Hello, finance fanatics and investing aficionados, and welcome to Investing Lighthouse. We are back with another fascinating episode on our channel, the only place you need to be for all your stock market, economic, and investing curiosities. So if you haven't done it yet, remember to smash that like button, subscribe, and join our ever-growing community. And today, folks, we're setting sail for a journey that takes us across the Pacific, all the way to China. Buckle up because we're diving into the world of demographics, economics, and how it all ties back to our favorite topic, the stock market. Let's kick this off with a fun fact to set the stage. Did you know China has the largest population in the world? As of 2022, China was home to a staggering 1.41 billion people. But, plot twist, for the first time in over 6 decades, China's population is shrinking. That's right. Just like the concluding chapter of a suspenseful novel, the dragon's population started to dwindle. Now, before we proceed, you might be scratching your heads, wondering, why does a country's population matter to the global economy? Or what does this have to do with the US stock market? Well, the population size directly influences a country's economic power. More people often means more workers, more consumers, and more innovation. But when the population starts to shrink, especially when it's the world's most populous country, it sends ripples across the global pond, touching everything from GDPs to stock markets. Let's peel back the layers of this intriguing story. First, let's delve into the why. The most prominent cause of China's shrinking population is its one-child policy, implemented back in 1980. This controversial policy restricted most couples to having only one child in an attempt to curb the rapidly growing population and alleviate social, economic, and environmental problems in China. At the time, the policy seemed like a necessary measure. In the years following World War II, China experienced a population boom. By the late 1970s, China had over 900 million people, and leaders were concerned about overpopulation and the strain on limited resources. Under the one-child policy, most urban couples were limited to having one child, while exceptions were made for some, particularly rural couples, ethnic minorities, and parents without any siblings. Despite the controversy and criticism, the policy achieved its goal to a certain extent. It significantly slowed the population growth rates and contributed to China's economic boom by reducing the dependency ratio, which is the ratio of non-working people, like children and the elderly, to working people. However, the policy also led to several unintended consequences, including a gender imbalance due to a traditional preference for male children, a shrinking workforce, and an aging population. Today, faced with these demographic challenges, China has reversed its stance on family planning. It phased out the one-child policy in 2015, replaced it with a two-child policy, and in 2021, introduced a three-child policy, along with measures to support families such as tax incentives and educational subsidies. However, changing a deeply ingrained mindset isn't easy, and younger generations in China, faced with high living costs, long working hours, and the pressure of caring for elderly parents, are hesitant to have more children. This reluctance persists despite the lifted restrictions, adding another layer of complexity to China's demographic puzzle. Plus, let's be honest, having more kids means more diaper changes, more sleepless nights, and fewer Netflix marathons. Now, coming back to the world of investing. These demographic shifts in China could have profound implications on global markets and present both challenges and opportunities for investors worldwide. So keep a keen eye on these changes, my fellow investors, as they could shape your investing journey in ways you might not have imagined. So how does this impact China's economy and, by extension, the global economy? Well, a smaller workforce could result in slower economic growth, impacting everything from manufacturing to innovation. China's workforce has been the backbone of its massive manufacturing industry, offering cost-effective labor to companies worldwide. A shrinking workforce could drive up labor costs, leading to higher prices for goods made in China. Yes, that might mean you'll have to shell out more for that shiny new smartphone or your kid's favorite toy. Moreover, a smaller, aging population means a higher dependency ratio. This means fewer people working and, therefore, paying taxes, while more and more people are relying on social security and health care, putting a strain on public finances. And remember, in the grand game of economic dominoes, what happens in China doesn't stay in China. So how does this affect our turf, the US economy, and the stock market? China has played a crucial role as a trading partner for the US, providing a diverse range of consumer and industrial products. If manufacturing costs in China rise, it could lead to increased import costs and higher inflation in the US. This can squeeze corporate profit margins and potentially dampen stock market performance. In the long run, it might prompt US businesses to consider other manufacturing destinations, causing a seismic shift in global supply chains. But here's where it gets interesting for our market mavens. The shift in manufacturing hubs could open up new investment opportunities in countries like India, Vietnam, or Mexico, where labor costs remain competitive. Imagine a new wave of growth and development in these countries. And you, our savvy investor, riding that wave before it becomes mainstream. Here's another angle. The shrinking Chinese workforce might also accelerate the country's push towards automation, potentially leading to growth in sectors such as robotics and AI. For eagle-eyed investors, this could mean attractive investment prospects in companies specializing in these areas. That said, a shrinking population and workforce aren't necessarily all doom and gloom for China. The country is also making strides in transitioning from a labor-intensive economy to one driven by technology and services. This can lead to higher productivity and living standards, benefiting sectors such as healthcare, finance, and technology, and possibly creating new investment avenues for our fellow stock market enthusiasts. Lastly, let's not forget about the impact on the currency market. A slower growth rate in China could potentially weaken the yuan against the dollar, making Chinese goods cheaper for US consumers and possibly benefiting US companies that source materials from China. However, this might also result in US goods being more expensive for Chinese consumers, which could impact US companies that rely heavily on Chinese demand. The takeaway here? The population trend in China, the world's second largest economy, can have significant implications on the global economic scene and, in turn, influence the US economy and stock market. This means that you, the smart investor, need to keep an eye on these global shifts and adjust your investment strategies accordingly. Now, remember, my fellow investing enthusiasts, the journey of an investor is like a never-ending game of chess. It's all about staying informed, making smart moves, and sometimes having the patience to wait for the game to unfold. China's population shift is one of those unfolding stories with implications that will continue to ripple across the global pond for years to come. And there you have it, folks. And that concludes our in-depth exploration of China's population shift and its potential repercussions on the global economy, as well as its impact on our beloved arena, the US stock market. We hope you found this as exciting as we did. Remember to hit that like button and share your thoughts and insights in the comments below. Until next time, stay curious, keep learning, and remember, the more we learn, the more we earn.